to this video. Why do you need to take partials? Why do you need to take partial profits at the nearest liquidity levels in trading? This video is about that. Before you is a chart for gold on the daily time frame, where we said there was a first break of structure here at the higher high. That's where we're supposed to take our order and potentially target this lower low. In the previous video we said as long as the market is in between this higher high and this place, this region, we would desire this low to be taken before this one, according to the bearish version of the standard trading model. So yesterday we did a top-down analysis on this this zone, whereby on the 4-hour minute time frame we found out that the market was reacting at this zone right here, still following the bearish version of the standard trading model. I want to repeat what I said yesterday. I just want to go direct to the point. So we said that there was a sweep of liquidity here, right, according to our model. Let me draw it good, like this. This is how it's supposed to be drawn. So there was a sweep of liquidity right here, and there was a first break of structure right here, right there. That's this guy around here. Then at this high we were expecting the market to react of that zone and potentially take this lower low right here. That is what we said yesterday. But I remember also adding that it's very important that when this zone is mitigated, it's important to take partials, because this market, as I went back on the daily to show you how the buyers was depending on this FVG, whereby you said out of the field of this SVG, mostly we tend to draw quickly to the next liquidity, which is this guy, this external liquidity up here, right? When this market moved up, it left some internal liquidity as a form of FVG, and so after being filled, market tends to move for that external liquidity. So I added that we should trade when this market hits this zone right here, and dropping down on the lower time frame, still on the 4-hour minute time frame. This is just what happened on charts. I'll just open the charts, and the market mitigated this region. Yeah, same following the bearish standard version of the standard trading model. Sweep of liquidity, first break of structure, it's high, so the zone mitigated, and there was a reaction here before the market continued to take this high. So this is what we are going to look at on the lower time frame. What did the market exactly do here? Because naturally we want to set our order here and take our stop loss right here. But if you were to overstay in the market, then this market would have made us a loss. The trade could be a loss. Dropping down on the lower time frame, this one was on the 15 minutes time frame. You can see this is on here. the way it was mitigated. The zone was mitigated, and you see the reaction. There was a drop of some pips. This is gold. I don't know exactly how many pips were they. Let's try estimate. Let's say this guy fell on 2037. Take away from let's say it was order was mitigated right there, 2037. Then this one is 2045. 2045, then 45 minus 37. That is 8. So it was around 80 pips. Or I am the one who is assuming things. It's around 80 pips right here. Market moves are around 80 pips. Yep. So 80 pips are good. Around maybe 50 pips, even those ones are good. So the market mitigated this zone, but the target was this lower low, right? But you see the market just hit this guy. Then at the nearest liquidity right here, you see it started to reverse. How could you have taken this advantage of this market over here if you are not the aggressive kind of a trader to set an order here and your stop loss above here? You could have dropped down on the 5 minutes time frame. This is what happened on the 5 minutes time frame. This is exactly what happened on the 5 minutes time frame. So after the market hit this zone, there was a first break of structure. Still the fractal nature of markets following this model. Our strip of liquidity, which we have right there with the dotted line. First break of structure. First break of structure. Then it's high right above here. Right above there. That's where the market reversed. And potentially hitting our take profit, which is this lower low right there. This lower low around this place. So we are seeing that lower low being smashed. And the market decided to reverse. So after this sweep of liquidity, you can see the clearest first break of structure. And then it's lower low. See the market reacting off of that zone, and boom. We moved up. This is the bullish version of the standard trading model. Yes. So what are the key takeaways from this setup? From this setup right here, because naturally we had anticipated this low to be taken, but I did insist that you should take partials at this some level here. So the key takeaways from this setup, I noted them down. Okay, before that there was a chart here. I broke this down on the previous video, and I said this guy, the market reacted off of this zone. You can check out the previous video on gold. That's hashtag number 2. I just hashtag it number 2. Yeah, the market reacted off of this zone, whereby it took an entry here. But I also pointed out the market will react off of this zone after it has been hit. This market was moving up after, because this one of the clearest first break of structure, right? And that is exactly what we are seeing. What has just happened. See this reaction off of this place. Let me show on the this reaction where this market reversed off right here. I am pretty sure it was that first break of structure, a higher high that we just seen on the other chart. So you can confirm the precision of this model with the first break of structure high, the way it is being it's being mitigated and the market reversing. So if it was a sniper entry, just set your sniper entry at that higher high, like this. Let me show you. A sniper entry right at that zone up there, and you could have rode that's 80 plus pips on gold. That 80 plus pips that just printed between this zone and this zone, from this place and where this guy was taken. But it's very important to confirm an entry because I've just insisted on it. So this one was the 15-minute time frame. We've just confirmed it on the 5-minute. With this guy. It was this guy. First break of structure, it's high. Let's take your entry. Stop loss above this guy. I hope it was not taken. This guy was not taken by. Yeah. But you set it above right there. And you can see the market barely hit that high and boom. Our target was mitigated. So the key takeaway is that I took from this setup on gold for the last 3 videos. This is the third one, the first, second, and this is the third one. Number one is having the bias, right? Having the bias is very important, and I mentioned out on the other videos that to have a bias of the market, it's very important to spend a lot of time on the higher time frames. Usually the weekly, the daily, the 4-hour. That is the most strong time frames to find the buyers. These are the most important time frames to find the buyers. Spending a lot of 90%, 99% of the time on these time frames, weekly, daily, 4-hour, maybe. Yep, and dropping down on the lower time frame, the 1 hour, then the 1 hour, we have the 30 minutes, 15 minutes just to place entries on. So to have a bias is very important. Is the market bearish or bullish? That's very important. For the next 3 days. For the next 3 days, is the market bullish or or bearish? Of course, you will end up with one of this: bearish or bullish. Yes. And the next point is bullish or bearish version of standard trading model. Yes. So if the market is bearish, then it means for the next 3 days we should be focused on looking at the bearish version of the standard trading model. We should be focused on taking partials or allowing the trade to move to our take profits with the bearish bias of the market. Strictly short on the bearish bias of the market and looking for the bearish version of the standard trading model. If it is a bullish market, strictly we are looking for the bullish version of the standard trading model and strictly longs for those next 3 days. Another point is that setting order limits fearlessly. Yes. So we have identified the bias that we are we are bullish for the next 3 days. So we will be looking for the bullish version of the standard trading model for the next 3 days. And at any point where it appears, you find a sweep of liquidity, first break of structure, then at its lower low of the first break of structure, that is where we set our buy order limit. Mark this term fearlessly. We sell those orders fearlessly. Yes, we don't hesitate when this pattern prints. Now, there will be an issue of the high quality setups, only quality trades, and those are trades that are not that are likely to be low quality. High quality trades, for me, I refer them as the ones that hit the take profit. This place right here, take profits. That once you set and buy order there, the market just rallies and takes and gives you a take profit. But other setups will try to give you some pips, some partials, and reverse against your direction. Those are low quality setups. That's where now the last point comes in. Know when to exit. Just how I have illustrated on the gold trade. So we were on our buyers for the last for the whole of this week has been bearish for gold, right? So we've been looking for the bearish version of the standard trading model all along. Look at this. This is where I began. I said after the sweep of this liquidity on the daily time frame, then this zone we drop down on the lower time frame and try to find out this model. We drop down on the 4-hour minute time frame. This is right here, and we see the model still printing the bearish version right here. We set our order here, and you are able to ride some pips down here. There was some trade here that we took and took our profit around here on the lower time frame, on the 30-minute time frame, still following this bias of the bearish version so that the trading model. Dropping down now yesterday, we were still looking at the bearish version of the trading model, but I also cliched of this high being taken, that we should take partials, and you've just seen what has just happened right here. Yeah, our order was triggered. There was some the market dropped down for some pips, around 50 plus pips, which will have taken, and now the market is reversing to take the high. That's exactly what I'm trying to illustrate here. If a bias is bearish, then we should looking for this model right here. But it should also consider looking at the market on the higher time frame, right? This guy, where I said your weekly, daily, and the H4, and see the potential direction where the market is likely to draw. Yeah, draw on liquidity. And the swing highs and the FVGs, right? And if you find out that the market is likely to move against your direction, and there is this edge right here printing out, you say to your order, take your partials at the right time. Yeah, know when to exit. Yeah, they say a good dancer always knows when to leave the stage, because if they overstay, then they'll tend to bore people, or they tend to lose their value. Yep. So you leave the market when it's still at that hype of selling, right, at this model. Yeah. When now the market is selling, that is when now you take your partials profit. Yeah. You don't wait for the take profit to be hit. That's how to survive in this market. That's exactly what this video was all about. And I hope you who watched this video, you've gotten something, and you've learned also something. I'm also learning, in the process of learning each day out as I trade. and it's a growth, right? Every day we find new things, and we add on our knowledge as we grow up on this trading industry. Real aim is just to make money in these markets. That's all what we wish to, what we as traders wish to every day. So if you like this video, just put a comment, and you can also share with your friends, sharing as you care. If you're new, you can also subscribe to the channel, and we work together through this this business. Thank you so much, and bye.